My name is Lois Epps. I'm a volunteer with SCORE, and moderating is one of the things that I do. So I will do my best to go through any of your questions, present them to Jerry so that he will be able to answer your questions. I will introduce Jerry. He is a founding member of the board of directors of West Valley National Bank in Avondale, Arizona. He has nearly 4 decades of community bank experience comprising commercial and corporate and community bank experience in estate lending, with a brief interest and experience with other industries, including golf manufacturing, aerospace, machine shops, medical, and healthcare. He's been active in numerous communities and organizations, including serving as a member of the California State University San Marcos Trust Foundation Board for 20 plus years as a member, also of the Palomar Family YMCA Board of the Escondido Rotary Club. Jerry is a graduate of San Diego State University and of the Southwestern Graduate School of Banking at Southern Methodist University in Dallas, Texas. He's an avid golfer and a hiker and enjoys photography and traveling and probably much more. Jerry's been a volunteer with SCORE for over 3 years. So with that, Jerry, I will hand it over to you to enlighten us on financials and funding. Thanks, Jerry.
Thanks, Lois. I appreciate all the kind words. Welcome to our SCORE presentation and simple steps to choose the right financing. Just to give you a little background, this
can't hear you.
Workshop, pardon? Can you hear me? Hello?
Yeah, we hear you just fine.
Oh, I'm sorry. So the background really was, this was a funding and finance workshop that has been somewhat altered to bring it up to the current technology and options that are out there. And one thing we're hoping to do today is to be able to introduce you to online business loans, crowdfunding options, invoice financing, and many more options. Today's world is obviously very different. And in order for us to gravitate through all the issues of the small business, in about 1953, some 67 years ago, Congress passed a bill to form the Small Business Administration. Part of that bill included SCORE, which is a nonprofit and free service to assist with small business. SCORE stands for Service Corps of Retired Executives. Well, today, honestly, we have many of our executives that continue to work, and some far from retirement, but in most all cases, our SCORE mentors have 3 to 4 decades of past experience in their special niches. One of our goals when we bring new clients into SCORE have initial discussion about what your specific business needs are. And then we try and pull in a co-mentor to allow us to give more specific coaching in your realm. So today, one of the things we're going to talk about is here we have 60 local mentors within the Greater Phoenix chapter. We actually have 3 chapters within Arizona. And believe it or not, over the entire country, there are over 11,000 mentors, some 300 offices, and we offer coaching and counseling via email, phone, webinars, and what's been popular recently is virtual counseling. And almost everything from SCORE is free. We are volunteers, we are not paid. And we are trying to give back based on our successes and passions within our own industries. So in beginning, one of the things that the Federal Reserve Bank did some years ago is they investigated how long it took an average small business owner to locate the financing they needed to help run their business. And astoundingly found that small business owners took up to 33 hours in locating financing that worked for their business. Well, that's nearly a week of production taken away from a small business. And as all small business can attest to, in most cases, you're working 24/7, it seems, so 33 hours was extensive. And today, the good news is we have technology. As Lois mentioned, I'm a traditional commercial banker. I'm probably kind of old school in today's terms, but when I grew up, banking was you come into the bank, you sit down, you give your loan officer your loan request, and you discuss your needs. If you have any collateral and how you're going to repay it. That then took extra paperwork and time. Well, in today's world, fast pace is a key with most small businesses. They don't have time, nor do they want to complete mounds of paperwork. So we have online, and we try now to find ways to match your needs to the technology. Some of the business in the past, you can see, were industries that were typically, as an example, retail, brick and mortar stores, very costly for the small business. Hard for the customers to sometimes locate you without a lot of effort. Well, now we have Amazon, diapers, and many other types of online search networks. It's literally endless, as most of us know. Travel industry, same way. You know, it used to be that you would go through a travel agent to decide whether you wanted to go on that great vacation, airplane flights, cruise ships, whatever. Then came the advent of Priceline and TripAdvisor, two of those websites that many of us use in doing our travel plans. Then the next one was real estate. How many of us have used real estate brokers and even classified ads to find that property that we want to buy or to maybe sell to the right buyer? Again, advent, Zillow in action. So it continues, as we all know, from the immense amount of shopping that we do online, and it's same with funding and financing. You know, it used to be the old story was at some point, I know in my lifetime, they said we would be a cashless society. It hadn't happened yet, but we're sure moving towards that. You can now deposit checks in your bank by your phone. And people are trying to get away from like the high credit card fees. So they're going to options like Square and PayPal. So along the way, one of our co-sponsors, by the way, with Score is OnDeck. They are one of the options of searching for other types of resources. There's Bill Float, Lending Club, and Kickstarter, which we will talk about a little later. The traditional loan lenders, like I was used to, usually had what they call loan application processes. Now, I kind of dispute that. I'm sure a lot of people would agree, but we really tried to honor a client's request. But again, in order to protect the banks and banks' assets and shareholder investments, we had to stack those credit files with enough documentation that we knew what we were doing. And don't forget, regulators often, about once every 18 months, they audit banks and can put a bank out of business if they find their file support is not adequate. So there was a reason for a longer application process. The other thing to remember is in traditional banks, your loan amounts were quite a bit larger. And lending is a risk business. So in many times, the risk had to be weighed against the return on investment. There's where fees and higher interest rates came in. Well, again, we talked about your personal credit score, big part of the old lending process. The thought was if you paid loans in the past, the probability of your character would allow you to repay them in the future. Now the online lenders, it's quite a bit different today. You have a shorter application process. You do have less paperwork requirements, and these are data driven. Their approaches are that they want to get loans out. The kicker is on this, and this is where a lot of times it's a catch-22 for a small business, is the loan amounts are smaller. Maybe they're from 10 to 25,000. And that might get you started, but then there comes a time, and hopefully within a year, because that's usually your traditional banks and lenders want you to have a year in business. They want to see a complete cycle where you've gone through ups and downs, you've managed to stay in business, make payroll, and keep a little for yourself. So one of the disadvantages, I would say, of the online lenders is you will be generally dealing with smaller amounts. And also the benefit on the online lenders, they will work with the younger companies that haven't necessarily proven themselves. So there's all kinds of new financing options. Here's some good examples. We have nonprofit lenders, we have crowdfunding, which we'll get into soon. It's a very new and very unique financing options, more funding than financing. And then we have invoice financing, and then the online lending. And then the final was loan matching sites, which is another very intriguing nuance of current lending and fundraising factions. Now, the nonprofit lenders many times will become business partners with a business, and they do the very small micro loans, $5,000 to $10,000. These kind of lenders are noted here, like Kiva Zip, Action, Tilt Forward are just a few. And what they're trying to do is they want to give back to the community. So they're obviously in business to make enough money to survive, but they're not in business to necessarily make a profit for owners or stockholders. You usually will pay lower interest rates, sometimes no fees, sometimes fees and no interest. Each one's a little different. The good news and benefits for this type of opportunity is it's really good for startups and micro businesses. It obviously is good for the community. They're very civic minded, and they really want to be involved with people and companies that give back to the communities. Sometimes these lenders are so involved in the community and believe so strongly in your business that you will not only get free mentoring and guidance, but you'll get lots of options to help you grow your business within that community. And then, of course, the consideration, as I just mentioned, the loans are going to be smaller, and they're usually not going to be in an element that would provide you ideals for expansion or special projects. Here's an example that I like of an eco-friendly clothing retailer that she needs to she wants to give a part of her revenue to a charity, but she needs $10,000 to expand her business. By giving to charity, that's not necessarily going to put her in quote good graces with a traditional lender, because they're looking strictly at your ability to repay. So in this case, who does this fit with? This purpose fits a lot with the micro businesses, and it really fits with the mission-driven businesses. And of course, a lot of businesses in underserved communities. And I'll give you a good example of that. I came from the Las Vegas area before I came back to Phoenix. And one of the really popular sources of funding for nonprofits with food kitchens, a lot of food kitchens for the homeless, homeless vets. So those are the kind of business that these lenders look for. Again, it's Action, Kiva Zip, and Tilt Forward. One of the things I would stress to all of you is that you're going to see quite a few names today on this PowerPoint presentation. And by the way, you will be getting a copy after we're done. So you will have a copy of all these slides to refer to the names. But I would highly recommend that you research each, go into their websites and find their uniqueness, because honestly, each one is different. Each one serves a slightly different focus. Their terms and conditions might be different. So it takes some legwork to find the right one for you. And it will take some time, no doubt. Lois, just a break. Has anybody got any questions so far?
Jerry, I'm not seeing any questions come up yet, so.
All right, we'll continue.
Yep, thanks.
The next one is crowdfunding. And this has been a recent generational thing where I think most of us remember crowdfunding by most of the time disastrous personal situations. Let's say your house burned down and you were without anything. You go to friends and family, but then this online networking of options to raise money for people that felt sympathetic to your cause. So they would invest in you. There was no repayment. They didn't expect money back. It was out of the goodness of their heart. So GoFundMe, ironically, in some of my research, has been around a long time. One of the things in research I did quite a while back is I noted that when the French were wanting to give the United States a token of their first 100 years in a democracy, one of the French gentlemen who wanted to present the gift to the United States on their 100th anniversary, which would have been around 1865. He started in 1864 and actually started raising money. He ran out of money, he needed substantially more than he thought. So he went out and raised $1, $5, $10 from numerous people that felt that was a really good gesture. So he raised in the neighborhood of about $400,000 back in 1864. That was a monumental amount of money. At the same time, he found a harbor entering New York that he wanted to put the Statue of Liberty on, but it wasn't tall enough. So he called on his friend Purlitzer, who you might know from the Purlitzer Prize fame. And Mr. Purlitzer went to the New York wealthy, and he raised $1,000 to $10,000 from many wealthy individuals. And bottom line is, between those two gentlemen, they raised enough money to build the 305-foot Statue of Liberty and the 300-foot pedestal that it sits on at Ellis Island. So GoFundMe's been around a long time. It probably wasn't called that, but some of the other funding organizations you'll see out there are Kickstarter and Rocket Hub. Indiegogo is another one that's very popular. One of the things that you do have to remember about these sites, and Indiegogo and Kickstarter are two that I would tell you have some challenges. One of the pieces of information that you really know when you seek out funding from these Indiegogo and Kickstarter is that there are criteria, and two of which are you have to set the amount of money you want to raise up front. Let's just pick a number. Say it's 50,000, as this example shows. So you might go out to 1,000 of your friends and raise 50 bucks. It's a good way to go, and it might take some effort, but the good news about that is when you do that, you also spread the word about your product or service. So now you've got 1,000 people that believe in your product enough to invest $50, and those people can spread the word. They can be your marketing team as to this great new product you've come across. The other kind is called investment crowdfunding, and this is where really people that invest, and they do invest rather than loan or donate, they expect something in return. So a lot of times you might ask for more money. In this example, you would ask, say, 10 individuals to invest $5,000. Well, because of that higher amount of investment, they're going to want maybe an equity stake. Maybe you offer the group a 10% stake in total. Or maybe you, in many cases, what they do is they offer one of their products or services free. So there's a lot of ways to negotiate this, but I think one thing that I like to point out to people when you're doing your research, make sure that you understand that in a couple of these, and Indiegogo and Kickstarter are two that I'm aware of, that you have to pick an amount. And let's go back to the $50,000. If you choose 50,000 as the amount you want to raise, then they give you initially about a 30-day window, and it can be expanded to up to 60. But once they hit the go button, you have a maximum of 60 days to raise that $50,000. If you don't, you get zero. So it's really important that you understand that maybe looking twice at the amount you need will be really critical, and how you go about it. Do you ask for small amounts, large amounts, or anything you can get? So those are the kind of things that you need to really think about as you're going through this various steps of fundraising. Now, it's interesting with the payment of fundraising. Obviously, these crowdfunding sources have to make a profit themselves. So they're going to charge you fees. Sometimes the fees can be paid up front, sometimes in the middle. I've seen a couple that even at an exit fee where they actually charge you a percentage too. And some of them, may have the equity investors that then want more than you're willing to give. So you got to really check out the payment options and restrictions of crowdfunding. The benefits we just mentioned, benefits you can get in front of potential investor supporters who can provide you not only financing fairly quickly, but also an option to do some marketing for you. And that's a big benefit. Marketing costs are usually about the third most expensive cost in any company's business. So that can be a really beneficial part of crowdfunding. Another one allows individuals with limited access to feel like they're part of something bigger than them. They're kind of buying into a concept or a product. And there's a lot of satisfaction in that. A lot of people don't have entrepreneurial spirits. They don't have the drive to own their own business, but they would love to be part of it. So that's something really to keep in mind when you're doing that, when you're spreading the word of your new product or business to your friends, and how you market is them wanting to be part of it. And then the third one, obviously, is your product really in demand? I mean, is there a market for your product out there? There's competitors in virtually every venue we can all think of. So one of our pitches within SCORE when we talk to small business is, do you think you can build your widget faster, cheaper, and get it to market quicker than your competitors who maybe have been in a business for 1, 3, 5 years? They've made a lot of the mistakes. As a new business, you're going to make a lot of mistakes, and you hope they're not big ones because you don't want to repeat them. So market validation in this case is a really extra benefit. And then the considerations. As this states, it can be very challenging. You have a lot of competitors. A lot of people want to sell a widget. Many of them have patents or trademarks, many do not. But it can be tough getting your product funded. You've got to have people that believe in it. And one of the important things that, again, in SCORE, we kind of walk you through is what's called a pitch deck. And that is basically a sales product. You want to develop a program where you can go into the interested buyers or investors and show them why they need to be involved in your product or service. So you've got to be a salesman, and you've got to practice a lot and try and make sure you answer all the questions before you get that pitch deck ready. Now, this is one of the things that is unusual. There's a thing called accredited investors. This is something that when you're in the market and on Wall Street, accredited investors, it takes quite a strong financial statement to become an accredited investor. I would research that online and find out what an accredited investor is. In some cases, that could eliminate what you're looking for in the crowdfunding choice you make. Here's an example of what might fit for a crowdfunding option. In this case, an aspiring business owner has an idea for a new type of kitchen widget. He estimates it'll cost $15,000 to design, and he needs to place an order of 5,000 units. So who's a fit? Well, first of all, he's new, he's not even in business, so the traditional bank probably, unless he collateralizes it with personal assets, probably won't be a fit. And yet, many established businesses with great ideas do get funded. They're going to look for market valuation. Again, what do you have that will not only sell a potential buyer, but how are you going to support the growth of your company, which will validate market acceptance? Invoice financing. Now, this is a kind of an unusual way to finance companies. It's not often used because it can be very expensive, but it is sometimes an option, especially in the apparel business. You get what's called factoring, which they actually factor their receivables. In other words, I sell you a suit and you don't pay me, so I have a receivable from you now. So I can take my group of receivables and present them to a factoring company. We'll look at them, make sure they're valid. And let's say I have 10,000 in invoices and they're spread over maybe 20, 30 different companies. It's really important that you don't have heavy concentrations. And if you do, let's say you've got one invoice from Costco that's $10,000 and you have only two other ones. Well, that's a heavy concentration and a lot of risk. So if they do that financing because of the strength of Costco, they would maybe only give you 60 to 70 cents on the dollar. And then when that invoice is paid, you get your money. There are some third-party invoice financing arms out there. Blue Vine, Fundbox are a couple that we mentioned here. You know, I guess the good news about this type of financing is you can get fixed, fully paid. You can work out terms where you pay or you're paid back based on the invoice. Or you can advance a percentage of your outstanding invoices, then they pay the remainder net of their fees when they receive payment. So again, it's not the best option, but it is an option. Again, this is telling you about you can receive cash early rather than waiting for those receivables to be collected. Again, they're typically for larger established businesses where they have a history of paid invoices. I know clothing manufacturers, again, and doing importing of their clothes from, say, China, you see a lot of that in the clothing business. Here's another example of invoice financing. This lady owns a small bakery and she's trying to goods for, she's got $10,000 in outstanding invoice. In other words, she sold $10,000 of her product and she really doesn't want to wait 90 days because it's a catch-22 for a small business. Most seasoned businesses are going to take advantage of the small business. So while typical terms in your industry might be 30 days, I'll sell you the product today and I give you 30 days to pay me. In some cases, in order for you to get their business, they will stretch you out 90 days. Well, that's a cash flow killer for a small business. So you really want to stay away from that if you can. There are times where the order and the intro to a company is worth taking that risk, but it is a risk and you need to measure that risk before you make that decision. So again, in this case, she wants $23,000 to solve her immediate working capital needs. So she pledges her accounts receivable invoices. Two things, again, that are important there. Number one is advanced dated invoices. In other words, invoices that are outstanding a long time. Generally, when a bank does accounts receivable financing, they will eliminate any receivables over 90 days, primarily because that's considered uncollectible. You might be able to collect it, but the bank might say it's been 90 days. We probably wouldn't be able to, so they would not consider a receivable over 90 days in your borrowing base. Let me go back. So again, possible options are Blue Vine and Fundbox. Again, I don't think you'll see this kind of financing very often, but it is a form that you should be aware of. Any questions so far, Lois?
Hey, I'm not seeing any come out yet, so
Okay.
hopefully we'll have some participation soon.
All right, no problem.
Mhm.
Okay, now on to online business loans. This is what a lot of you probably are interested in. The benefits here we can see are, it's a short application process. You can do it online. There's no in-person requirement. That's obviously extremely convenient. Saves you gas mileage and all those kind of frustrations of finding them. You do get generally quicker approvals than your typical banks. Here are some of the lenders that you can look online to. Again, you are going to be getting a copy of this PowerPoint presentation, so these names will be available for you to do your own research on. These online business loans sometimes require interesting repayment. As an example, some of them, they loan you the money and they might want to automatically debit your business bank account on even a daily or weekly or monthly basis. That seems awkward. Most people are sure used to monthly, but if you have the kind of cash flow stream that allows you to pay down that debt quickly, it's going to save you interest. And of course, it's less risk for the online lender if they can get paid back faster. Approvals, again, can be very fast. Decisions are based more on than just your personal credit. That's something the traditional lenders, credit is a big factor. Some of these online lenders, not as much. And I think the other thing that's really fascinating about this particular type of lending to me is you can really calculate your return on investment, quicker than you can in other types of loans. So it's something good to check out. The negatives, there are virtually no startups and it's not available in a lot of industries. This is kind of really a retail type business loan transactions. The access and interest rates are correlated to risk. Again, don't forget that lending is a risk. And I don't care how you collateralize it or what kind of cash flow stream you have, you are going to be looked at as a risk with any kind of lender. Now, the way traditional lenders mitigate against this risk is they look at your income stream, they look at your stream of income and say, does their monthly income support monthly repayment? Or they look at collateral, things like accounts receivable, your inventory. When you buy inventory, you either turn around and sell it or you add value to it through service. And that adds the value to the product, which allows you to create a receivable. And that's what the bank relies on for repayment. But don't forget, a lot of times when companies start having struggles and have really difficult times repaying bank debt, one of the things that banks have learned over 100 years or more is that when loans go in default, the primary source of repayment, which could be your daily income stream, you sell something, you get cash, you repay the debt. Well, when loans go in default, that income stream disappears or is substantially reduced. So what you want to do is then go as a banker to collateral. And let's say they give you equipment. You have tractors and trailers or forklifts and they owe you 10,000 and the forklift's worth 40. Well, unfortunately, you might have to take the forklift and sell it to pay off the loan. Or if you've given them a second on your house, they might say, we're gonna convert that house and we're gonna call the loan. So some of these situations can get pretty desperate, but I always try and tell people, remember, if you were the banker and you were loaning money, how would you get that money back? How would you be assured? Well, there is no assurance unless it's a savings secured loan. So that's where risk comes in, and that's where fees and interest rates mitigate that risk. Here's some alternate sources of funding that I've added here. Again, you can go through these and look at them. I frankly haven't checked these out in a while, and we are in a COVID time today, and I truly don't know whether some of these lenders are really strong and this time is excellent for them, or where they've suffered as well. So just check them out. There's some more options for you. So how do you know what product is right for you? Well, we've talked about non-profit lenders, crowdfunding, invoice financing, online lending, and how about loan matching sites? Here's an interesting chart that shows on the bottom. This on the bottom, as you go left to right, shows the ease and cost of the access of capital. Banks traditionally are the easiest ones to find and to request your funding from. They're also generally the lowest cost way to borrow money. Then you get to factoring. Factoring is more expensive. It's a lot more risk reward type benefits to a lender because they are charging heavy, but there are a lot more risks. Then the online loans. You're going to have less access to larger dollar volumes with online loans. You're going to have probably a little harder time with those because you're going to have a lot of competition. And don't forget, just like you, if you're a business and you're out searching for vendors, you're going to try and get the best price you can. Well, when lenders make loan decisions, they're comparing your request, and sometimes it's very almost inadvertent, but they're comparing your request to ones that might be in the pipeline, and they might think, see, I can make the same loan amount to XYZ company and I can make more money and be maybe more assured of repayment. So when you're looking at online lenders, they're going to kind of have that same criteria. They're going to say, you know, this loan looks like a slam dunk payback. I won't have to chase these people. They have a good track record. So that might be a good option. And then the fourth, merchant cash advance, very expensive way to go. Again, options. Sometimes you get in situations where you need something quick, and this is a good way to go, but expensive. And let me take a step back a minute and then give you one of my spiels that I used to tell my clients all the time, and I've told a lot of folks while I've been with SCORE. One of the things you need to know as a small business is you need to know your banker. And I would bet that most of you out there don't know your loan officer, don't know your operations officer, but maybe know the teller, the one that you see when you go into the bank the most often. Even if you don't think you're going to have a need for a loan today, stop by and introduce yourself to a loan officer. Get to know them. Talk about what the bank offers. They're in business to make money. They want your business. the more you get to know them, the easier it is to come into a bank when there's an urgency. And this is one of the things that used to bother me. I know it's human nature, but I would have clients come in and tell me that they had this urgency come up and they have to have $50,000 by day after tomorrow. Well, I'm afraid they know the answer. If you don't give the bank time to get to know you, to assess the credit file, to look at your accounts receivable, to look at your financials, to run your credit check, that all takes time. And if you can do all that up front and get a credit file prepared, then someday you might run in and it's going to save you a lot of time and headache because they're going to recognize you. So just a sidelight, really do that. It's very, very important. And in today's world of going to ATMs and drive-throughs and banking online, a lot of people don't do it. And if you're an individual customer, that's one thing. But if you're a customer that does business with a bank, you need to know your banker. So which would you prefer? This is a very interesting exercise. Now, when you look at it, this shocking 67.5% APR sounds crazy. 22% sounds better. But when you look at why, the 67% really only paid $1,500 in interest, but the 22% paid $4,800 in interest. Why is that? It's how long they use the money. It's a simple factor. How long do you need the money? So in case one, the guy borrowed $10,000, but he only needed it for 6 months. So his cost was $1,500. If you annualize that, that comes out to 67%. But if you go to the $10,000 borrowed, but he wants to pay it back over 4 years, then you're stretching out that cost. So it's going to lower your periodic costs. So I hope that makes sense, but that's one thing to consider. Don't just look at the APR, but that is important. We all want to do that. Here's a good one to talk about. Here's a well-established restaurant owner who wants to improve his capacity by adding outdoor seating. So he's saying he needs $75,000. Well, who is the right fit? You know, you establish businesses already generating revenue. So his potential sources are Funding Circle, Smart Biz, Cabbage, OnDeck, and there's quite a few out there. This is the type of loan that is not going to be paid back in a one lump sum. This is basically a capital injection, what is generally paid back over time. It's not like he needs the money and he's going to get an immediate rush on his restaurant and make enough money to pay the $75,000 back. One of the things to also remember when you're approaching a lender is they try and match the purpose with the repayment. Purpose of loan funds is very important. And I know a lot of people ask me over the years, why do I need to tell you what I'm going to use the money for? Well, first of all, you can always fudge and give them, you know, a false excuse of what you're going to use, but they primarily do that to, number one, make sure it's legal, and number two, try and match the repayment term. Sometimes you don't need 12 months or 24 months, you need 3 months. And sometimes you might need 6 years. So they want to know the purpose of the loan proceeds and how that is going to enhance your business. How is paying back that loan going to make your business better? Now, here's something I'm getting into that might be a little off base because it's used in larger loan transaction, but it's something called letters of credit. And in some of the lending that I did with the larger companies, what happens here is you apply for a line of credit with your bank. And let's just pick, I'm going to pick some numbers that are kind of out of the ballpark, but let's say your line of credit need is 100,000. Then, so you have a line of credit approved by the bank that's sitting there and it's unfunded. So meaning you're not paying any interest. And basically with a phone call, you can have that bank deposit 10,000, whatever you want into your checking account, and you can pay it back anytime you want up to the maturity of that line of credit. You do pay monthly interest on any amounts that are outstanding. But let's say you need a letter of credit. So they earmark funds under your line of credit. And many times letters of credit are issued for foreign transactions. As an example, if you're importing goods from China, when they get to the US border, you're going to have a customs agent that's going to look at your inventory, look at the inventory you've ordered from China, and then he's going to look at your payment documents and see how they line up with paying the invoices. And this is almost like, if you think of it as an escrow, you know, this Chinese company doesn't want to give you goods until they're paid, and you don't want to pay them till you have the goods. So you're in a catch-22. So this letter of credit can be a performance letter of credit, which means they use the letter of credit and documents contained to pay the invoices. Now, a standby letter of credit is used a lot of times when the purchaser does not intend to use the money that's backing the letter of credit, but his credit standing or trust is not as good as the bank's. So the bank issues the letter of credit to your customer, and then you pay the customer back in your normal terms. So you pay them in 90 days. But if you don't pay them in 90 days, then your customer has the right to draw on this letter of credit to assure that he gets paid. Most of the times, these letters of credit don't mature past a year, and they do charge percentages. A lot of time, a letter of credit fee could be in the neighborhood of 2 to 3%, but it's just another type of financing. You do need a good relationship with your bank. I think banks are primarily the ones that issue these letters of credit, but just something to kind of be aware of. And then we're to our last one here, and it's called match funding. You can see a lot of times you know how much money you need and the product you're going to sell, but the lenders you're seeking don't necessarily like loaning on your product or your widget. So you go to these match funding sites like SBA Link, BoFly, Fundera, Lendio, there's some other ones. And you contact them. Well, they are not the lenders, but they are the go-between. So they'll charge a fee to the lender if the transaction gets approved. And it allows you to get in front of a lot more lenders that not only can you spread the wealth and eventually have 2 or 3 sources, but they match the funding to the lender, and you don't have to spend all your time searching internet, and it's a lot of time and effort and work. So this could be a good option for you. In this case, it won't cost you because the matching site is going to pay fees to the lender. Again, good for you. In this case, the borrowers can get in front of significant numbers of lenders very quickly. Big benefit really in today's world. It will filter out lenders that are not a match, and you don't need to waste your time with them. And then at the end, it can help find lenders you normally would never find. That's a big benefit because there are so many out there, some credible, some maybe not. So it really is important that you do your research, as we've said before. You must still apply to each individual lender. In other words, you can't apply to a Lendio and have them shop it to each lender. You have to find the lender, apply directly. They do have pretty strict requirements, as you might bet, because they get a lot of requests. You may contact a broker, but again, the lender you have to go direct to. They're the ones that are going to be doing the credit underwriting and approval process. So before you start your search, you have a 4-question checklist that we should go over. And this is critical when you're thinking about you need money. Every small business does. Every startup does. You've got to try and ask yourself many questions, but these are 4 that I've kind of pulled out to get you to kind of think about. First of all, what types of financing can I qualify for? Well, if you're a startup business, the first thing you can do, unless you're fully collateralized by 100% grade stocks or savings accounts, CDs, is you can't go to a traditional bank. You can go to an asset-based lender. Again, you can pledge maybe accounts receivable, maybe inventory, maybe even some equipment. And you can look for unsecured loans or credit lines. Again, these are going to be ones that you're going to have to probably be in business more than a year. And generally, you're going to want to stay away, at least initially. I would always recommend that you get to know a banker. And even though you might not qualify, and the banker might tell you it's a little early in your business cycle to apply for their types of lending, just get to know them. It's really, really important. And then which of these is the best fit for your business? As an example, you're not going to want to do working capital injections and pay it back monthly. Working capital, which by the way, many people don't understand, working capital by financial definition is current assets minus current liabilities. In other words, current assets primarily are your cash and accounts receivable. Current liabilities are your basically current liabilities. They're your accounts payable and maybe utilities, things like that. So you want to try and fit the business with what matching you need for funding. And then one that's really important, how much do I really need? I can't tell you how many times over the years I've had people that say, well, I want to get as much as I can. That's not a good question to answer for a banker, because one of the things that, again, traditional lenders will look at is if you give them an amount you need, and we assume you know your business much better than we do. And let's say you come to me and you say, I need 50,000. And after I do a review and approval of your financials, I find that maybe I can only qualify for 25. I'm not going to give you 25 because you've told me you needed 50. And what's the worst thing banks can do is throw bad money after good. If they made you 25, they felt that's what you needed. But if they knew you needed 50, their first thought is, well, how is he going to get the other 25? And if he doesn't, how in the world is he going to pay my 25 back? So those are things you want to really think about. And the other thing is, of course, do I have all the information I need? Very, very strongly urge you really prepare yourself and do a speech, do a little interview in front of your mirror. And when you go in, be prepared for questions. One of the things I used to do, and I'm glad to do this as your SCORE mentor, is to allow people to run by questions. One of my goals, obviously, banker, is to get new clients. Well, sometimes I would go into a business and they weren't ready to change banks, but we got to know them. And I said, if you're getting ready to go to your bank and ask them for a big loan, if you want to run by your financials, run them by me and let me give you kind of a bird's eye view of what I would tell you. At least you'll be prepared when you go to your banker to talk to them about the options. So never go in unprepared. It could really be a death sentence for you. So your capital needs and considerations, obviously people, hiring people's the second most expensive part of running a business. Usually your facilities cost, rent, ownership of a business are number one. Marketing's right up there after people. If you're going to expand and open new locations, that's expensive. You got to do your research, know that the dynamics and markets in the areas you're going to want to move into will support the competition you're going to face. You're always going to be in a position, if you're a product person, to buy an inventory. You want to try and buy inventory cheap. So many times, if you can buy bulk orders, you'll get a discount, but then you need to come up with the money up front. So it's a catch-22. But bulk inventory buying is by far the cheapest way to resell because your margins increase dramatically. Then purchase equipment, delivery trucks, forklifts, whatever. Cash flow management. We had a term years ago, and I don't think it ever would not be important. That is, cash is king. Cash is the number one reason bank or small companies fail. They just manage to run out of cash. It's a scary thing to see when you've got a viable business and you run out of cash and don't have access to capital to fund. Maybe it's a bridge, maybe it's a very temporary thing, but without it, you can't get to the next step. Really, really important. And then the final one in this example is new business ideas. I mean, the amount of entrepreneurship which has built this country, I believe it's 73% of all business income generated is from small businesses, which the US Department of Commerce describes as any business under 500 employees and $10 million in revenue. So new business ideas are out there all the time. And these things we're on the right here, we're talking about, the amount, figure out how much you need, how long will it take you to pay it back, what's it going to cost you, or what is your return on investment going to be, and how good is your cash flow. Here's some examples of what you would do with certain types of business requests. And I'll go through these kind of quick. I think we're getting a little short on time.
Yeah, Jerry, I was going to mention that because we do have a couple of questions that have come in. So do you want to complete this phase first? And
I'm just about done. I have about 3 more slides. So let me hold those off till the end.
Okay, great. Thanks.
So in this case, if you're going to do a $300,000 franchise request, you obviously are going to have to go to a matching site. Not everybody's going to be able to fund that kind of money to purchase a franchise. You could try online business loans. I don't think that's a good option though. If you're going to develop a new product, crowdfunding, 15,000 might be a great way to go. If you're going to buy discounted inventory, another really good way to use your credit line at a bank. And then managing cash flow during receivables gaps. You've got a lot of assets, you got a lot of accounts receivable, but it's not cash today and you need cash. And then launching maybe a new marketing campaign for a new location or expanding your market presence where you are now. All right, well, that's the basics of our presentation. Lois said we've got some questions, so I'll open it up and hope to help you.
Yeah, so we have 3 questions pending so far. The first one is, are lenders providing loans during these COVID-19 days?
The answer is a hesitant yes. Again, if banks don't make loans, they die, because a bank's primary asset is your loan, and their primary income is your interest payments. So banks have to make loans to survive. Your deposits, if you have a checking account, you have a savings account at banks, that's a liability to a bank because they owe you that money. So in short, yes, banks want to make loans. COVID changes the conditions. When a banker looks at a loan, there's 5 things that national banks look at. It's called the 5 C's of credit. And I'm probably gonna miss one of them, but it's capital, conditions, collateral, capacity, and I knew I'd forget the 4th one. But anyway, 5 C's of credit. So definitely they want to know you have the capacity, but in conditions, they're looking at economic conditions. Right now, we know they're not good. If you're a new restaurant just starting up, you're not gonna have any luck getting a loan from a bank. Just not gonna happen. So you have to look at the position you're in, but banks are making loans. Admittedly, they're harder to get. The terms might be tougher, the interest rates might be higher because the risk is higher. We're in uncertain times. Next question.
Thank you, Jerry. So the next question is, do you get a better rate using loan matching sites?
Generally you will, but the conditions, the interest rate is one thing, but the conditions under which you both use the funds and repay it can maybe outweigh a little higher interest rate. So again, I really stress that any of these matching loan sites and these crowdfunding loan sites or borrowing sites that you really research them. And you can just Google. I mean, there's a lot of them out there now. Some I noticed have halted, maybe stalled some of their lending practices because of COVID. And I'm thinking by the 1st quarter of next year, I think hopefully that they'll loosen up and be more readily available. But there are availabilities out there, and banks need, as I said, to make loans. So, but I would think the matching sites, just shop them.
Okay, thank you, Jerry. All right, it looks like the last question that came in just now is, when will a comprehensive business plan be needed?
Well, you know, that's a really kind of a current question. We use within SCORE something called the Business Model Canvas. And it's a abbreviated 1-page document that I believe the Harvard Business School kind of started. I could be wrong on that. But they, it allows you to look at kind of the 5 main facets of a business and do your projection without spending 20 pages of a formal business plan. And I would say you can go on the score.org website and go to score.org/templates and look for business plans. You can go to bp.com, businessplans.com. But I would contact one of your SCORE mentors, look for a SCORE mentor locally, just go to score.org and look for new mentors, and then have them walk you through what a business model canvas is. Because I think in most cases for smaller type loans, that's adequate. And what that document does is it just gives the person on the other side of the desk, the lender, an option to kind of think how you're thinking. Where are you going with this business? How are you going to find your target market? What do you know about your competition? How are you going to price your product or service? So these are all things you want to think about a lot, do research, and then maybe that business model canvas might work for you.
Great. All right, so we have another one that came, this one is a little comprehensive. So do you have any recommendations for obtaining real estate loans for a startup company that is building a portfolio of rental properties?
Yeah, I think I've had a request recently about that very thing, as a matter of fact. And here's what I've told a lot of people are getting in a ramp up mode, start doing flippers. And I think we're at the top of the market. I mean, nobody knows for sure. We can all guess. But if in fact we are at the top of the real estate value market, it's going to level off. And then as recessions normally occur every 8 to 10 years, we're pretty much close to that. So if history is any relevant to the past, we're going to probably see values of our homes dropping. And when that happens with the unemployment rate, people can't make their payments. Then the banks foreclose, and the banks have all these foreclosures they want to get rid of, so you can go in and buy them cheap. So the bottom line is most banks, if it's not owner occupied, they change the down payment, interest rate, and terms. You'll pay usually a higher loan fee. You'll pay a higher interest rate most of the time. But the one thing you definitely will do is have to put a lot more money into a house. So if you're trying to accumulate properties in order to rent them out or to fix them up and flip them, the best financing obviously is to have the owner carry it. That's going to be probably pretty tough in the market we're coming into, because I would think many owners that are selling are trying to get out, find cheaper housing. So, it's all a guess. Nobody knows for sure. So I would say, if you're trying to build a portfolio of real estate, and let's say you're going to keep them for future appreciation and rental income, you're pretty much going to end up having to pay the standard 80, maybe you can get some 90% loans, but I would doubt. And I think the more we get into a potential recession, if it comes, those loan to values will continue to drop.
Great. So I hope, thank you, Jerry, for that answer. And I hope that has answered everyone's questions. And just for a real quick recap, does anyone have any final questions? We're getting to the half hour now. I don't see any additional questions coming in. So with that said, Jerry, we thank you very much for your time and offering your expertise on this topic. And I'd like to let everyone know that you'll be getting a survey that we would appreciate you completing and sending back. I believe Jerry at the beginning of the workshop indicated that we here in Phoenix, we have mentors available for any of your startups, your ongoing businesses and such, and readily available. So feel free to contact us whenever you feel the need to have some assistance to move forward in your businesses. Also, you can register for upcoming workshops. Jerry mentioned the BMC, the Business Model Canvas, an excellent workshop. I really encourage you to look for that coming up, I believe, in December, and many more workshops that we have coming up for the rest of this month and the end of the year. So feel free to register for those as well. So again, Jerry, I don't know if you have any final words.
Well, I'd be really happy to help you out if you have any questions you haven't come up with today and want to email me, or just contact score.org for the Greater Phoenix chapter. You can look into profiles and find a profile of a mentor that might fit your business better, but any of us are there to start with you, and then as your skills and needs direct, we will bring somebody else in to work with you.
Perfect. Thanks, Jerry. All right, so I think that closes out our workshop for today. We want to thank you all for attending. We really appreciate your attendance, and we hope that, and we know that this was helpful, but we hope specifically for your endeavors. And we're always excited when we get business owners, new business owners, existing, because it's a great opportunity for us to assist in the market of small businesses. So thank you again for your attendance. We appreciate you being on board. And Jerry, thanks so much for sharing your knowledge. And we look forward to seeing everyone again, and have a good evening, everyone.